Hey, James here. And if you've been paying attention to silver over the past few weeks, you already know that something historic is unfolding in the precious metals market, something that has the attention of every trader, analyst, and institutional investor who follows metals on a global scale. Because silver, which many thought of as a stable, traditional hedge and a store of value, has suddenly erupted into an arena of extreme volatility and opportunity that feels almost reminiscent of crypto. Markets, with a 17% rally in just 2 days, shaking the foundations of market sentiment and forcing everyone to reassess their assumptions. And here's what makes it truly extraordinary. Michael Whitmer, the head of metals research at Bank of America, one of the largest financial institutions in the world, has released a forecast for silver that is, for lack of a better word, jaw-dropping, suggesting a potential target of $309 per ounce by 2026, which, when you understand the math behind it, when you break down the historical gold-to-silver ratios, when you factor in industrial demand, structural supply deficits, geopolitical risk, and technical momentum, might not be as far-fetched as it seems at first glance, because silver, currently trading around $81.50 per ounce as of February 10th, 2026, has just emerged from a period of unprecedented turbulence, having experienced a 26% one-day crash on January 30th, a follow-up 20% drop in the subsequent week, and yet has staged a remarkable rebound, rallying 10% on February 7th and another 7% on February 9th, demonstrating that the underlying market structure is resilient and that the physical demand for silver, particularly from industrial sectors such as solar energy, electric vehicles, consumer electronics, and defense, is absorbing these shocks and maintaining a floor beneath prices that paper markets alone could never create. And it's crucial to understand that this isn't a story of speculation alone. The market has now entered the fifth consecutive year of a structural supply deficit, with a cumulative shortfall of 820 million ounces, nearly a full year of global mine production having been drawn down from inventories, consumed by industrial demand, and permanently removed from circulation. And despite doubled prices providing an incentive to produce more, major miners like Fresnillo have reduced their 2026 production guidance due to declining ore grades, logistical constraints, and the years-long lead time required to bring new mines online, which means that the market cannot respond instantly to price signals, reinforcing the thesis that silver's trajectory is increasingly driven by fundamental scarcity rather than transient sentiment. And when we examine the technicals, the picture is equally compelling, because after the violent corrections of late January and early February, silver has stabilized between $75 and $82 per ounce, reclaiming its 50-day exponential moving average, suggesting that the backtest of speculative excess is complete. Weak hands have been washed out, margin calls have been absorbed, and the market is now positioned more rationally, with trade sentiment shifting from panic to neutral to bullish, targeting resistance at $94, psychological milestones at $100, and the all-time high zone of $117 to $120, with Fibonacci extensions indicating potential breakout targets of $140 and $180, all of which, while substantial, remain conservative compared to Bank of America's extreme $309 call. And this forecast itself is rooted not in fanciful speculation, but in historical precedent, because the gold-to-silver ratio, which currently sits at approximately 62-1 with gold at $5,000 per ounce, has compressed in prior bull markets to 32, 1 in 2011, which would suggest a $135 target, and even more dramatically, to 14-1 during the 1980 Hunt Brothers squeeze, which is the basis for the extreme 309 figure, indicating that if historical dynamics repeat under current macroeconomic and industrial demand conditions, silver could outperform gold dramatically in the coming years. And the industrial story further reinforces this thesis, as the global shift toward electrification and renewable energy means that silver consumption is growing structurally, with electric vehicles requiring nearly twice the silver of conventional cars, solar panel manufacturing expanding at an accelerated pace due to global energy mandates and AI-driven infrastructure, consumer electronics increasing silver content as devices become more sophisticated, and defense modernization programs around the world, driving demand for high-conductivity metals that cannot be substituted, which collectively creates a baseline of price-insensitive demand that provides a safety net under the market. While on the geopolitical front, Tensions in the Middle East, uncertainty surrounding US-Iran talks, and the absence of clear de-escalation signals mean that capital continues to seek shelter in precious metals, further supporting price stability even in periods of extreme volatility. And while the paper market has historically exaggerated price swings, the combination of these structural factors, historical ratios, and technical resilience forms a multi-layered argument for significant upside potential, albeit with clear risks, including the possibility of prolonged hawkish Federal Reserve policy under Kevin Warsh, which could strengthen the US dollar and pressure non-yielding assets like silver, potential demand shocks if global economic growth slows, continued dislocations between paper and physical markets, and the uncertainty inherent in monetary policy shifts, all of which demand disciplined risk management, careful position sizing, and awareness of the extreme whipsaw potential in this market, because a 26% one-day crash is not theoretical. It's historical fact from just weeks ago, and as the market now tests the $81 support zone, eyes are on whether this level holds, whether immediate resistance at $94 can be broken, and whether the path to $100, $117, $120, and beyond into Fibonacci extensions is validated, while the options market, as evidenced by a March put-call ratio of 0.92, signals that sophisticated traders are preparing for movement in both directions, suggesting that volatility will continue to be a defining feature, but for those who understand the structural supply deficits, industrial demand growth, historical ratio frameworks, and the technical setup, these fluctuations represent opportunities rather than obstacles, because accumulation during dips is supported by fundamentals rather than speculation, and even if the extreme $309 target is viewed as improbable by some, the directional thesis remains intact. Silver, after this cleansing of leverage and sentiment, is positioned for potentially historic upside, driven by real-world physical demand, structural supply constraints, historical precedent, technical momentum, and geopolitical risk. And whether you are a trader, investor, or physical stacker, understanding the nuanced interplay between these factors is critical, because this is not a simple buy and hold market, but a sophisticated environment where timing, risk management, and awareness of both macro and micro factors determine outcomes. And as we continue to monitor the trajectory toward mid-February and beyond, the unresolved questions of Fed policy, ratio compression, industrial demand fulfillment, and the reconciliation of paper versus physical markets will provide the next chapters in what is shaping up to be one of the most extraordinary and volatile bull markets in silver in modern history. And the key takeaway for anyone paying attention is that while the path is volatile and the upside extremes are speculative, the fundamentals have not changed. The deficits remain. The demand continues to grow, and the technical structure, after surviving two massive crashes, is cleaner than ever, which together form a compelling argument that silver, despite its short-term shocks, may be on the verge of a generational move, making it critical for market participants to engage thoughtfully, respect, risk, consider historical analogs, watch key technical levels, and maintain awareness of macroeconomic, geopolitical, and industrial trends. Because in a market where one day can see a 26% swing and the next day a 17% rally, preparation, strategy, and patience are the only tools that separate successful participants from those who are caught off guard. And as we move through 2026, the interplay of gold to silver ratio dynamics, supply shortages, industrial consumption, geopolitical risk, and technical momentum will continue to dictate silver's trajectory, offering both unprecedented opportunities and significant challenges for traders, investors, and stackers alike. And while nobody can guarantee the extreme outcomes projected by institutions like Bank of America, the combination of historical precedent, structural fundamentals, and technical validation provides a framework to navigate this extraordinary market intelligently and strategically, making the current environment one of the most exciting, data-driven, and high-stakes chapters in the history of precious metals investing.